the Federal Reserve raised interest rates again today, its 10th consecutive hike.
Well, the market obviously expected 25 basis points. That was not a surprise, I think, to anybody.
I'm not surprised by the rate hike. I think that was market consensus, and it certainly was our consensus going into this meeting. But I think it just shows just how serious the Fed is about getting inflation down.
I think the bar is very high for the Fed to do another increase.
As expected, the Fed raised the interest rates by 0.25%, bringing the target range to 5 to 5.25%. Now, everyone's wondering, will the Fed's raising interest rates in the middle of a crisis fuel the fire to another financial crisis like we had in 2008? How does the Fed's rate hike affect the economy and market? In this video, we will explore Peter Schiff's viewpoint on the recent rate hike by the Fed and discuss the implications for the U.S. economy and the financial markets. He has also provided some insights on what to expect from the Fed in the coming months. So, stay tuned till the end of the video to know more. And be sure to subscribe to my channel for more latest updates on economy, crypto, and market. Let's dive into the video now.
Well, the Fed did it again. They raised interest rates another 1/4 point. So the Fed funds target range now is 5 to 5.25. Now remember, initially, I thought that they might not have hiked. This was a while ago. Based on the beginning of the financial crisis, I thought that might have been a catalyst for the Fed to pause. But then the Fed made it pretty clear that it wasn't going to be distracted from its mission. It never really acknowledged that this was a financial crisis, kind of like a mere bump in the road, nothing to really worry about. And so the Fed made it clear, and the markets anticipated that the Fed would, in fact, hike by 25 basis points. And that is exactly what they did. That's what I've been expecting now for the last couple of months, because I know from past experience that the Fed always does whatever the markets expect it to do. It's kind of afraid to do anything different than what the markets expect. So it waits to figure out what the markets want, and then that is exactly what it delivers.
The Fed's decision to raise the interest rates by 0.25% in May of 2023 was widely anticipated by the markets, but it also sparked a lot of criticism and controversy. The range of 5 to 5.25% is the highest since 2007, and it reflects the Fed's determination to fight inflation, which has been running above its 2% target for months. However, some analysts like Peter Schiff argue that the Fed is ignoring the signs of a slowing economy and a brewing financial crisis, and that it should pause or even reverse its tightening cycle.
He also mentioned that the Fed was going to remain focused on the dual mandate to promote employment and price stability. He talked about how important price stability is, and then said that he wants to make sure that we get inflation back down to 2%. Again, I've pointed this out. If prices go up 2% a year, they ain't stable. Stable prices stay the same. That's the definition of stability. Not going up every year, that's not stable. So the Fed says one thing, but does another, because it doesn't really want stable prices. It wants prices to go up because it wants to create inflation. It just thinks that if they only have 2% per year inflation, that it's not that bad. Well, it adds up. And of course, their 2% is really 4 or 5%, and that's a lot of inflation. He admitted in the prepared remarks that the economy had slowed considerably last year, so he admitted that. He talked about a slowdown in the housing market, in fixed income. He attributed that to the higher interest rates. But he did keep focusing on the fact that the labor market is still super strong. The unemployment rate near 50-year lows. Of course, we're not measuring it now the way we did 50 years ago. But of course, he doesn't bring that up. He's talking about how we have this really strong labor market. And so, rate hikes can continue because the Fed is not worried about the employment part of its mandate. It's only worried about the price stability. And he admitted that inflation is still much too high.
Peter Schiff criticized the Fed's policy of inflation targeting and interest rate hikes in a recent interview. He said that the Fed was contradicting itself by claiming to pursue price stability while allowing prices to rise by 2% every year. He also pointed out that the Fed was ignoring the signs of a slowing economy, such as the decline in housing and fixed income markets, and focusing only on the low unemployment rate. Peter Schiff has also warned that the Fed's actions would lead to another financial crisis, as they did in 2008. He said that the Fed was creating artificial bubbles in the stock market and other asset classes by keeping interest rates too low for too long and printing money through quantitative easing. He said that these bubbles would eventually burst, causing a collapse in asset prices and a surge in inflation. The Fed would then have to choose between raising interest rates to fight inflation, which would cause a recession, or keeping interest rates low to stimulate the economy, which would cause hyperinflation. I hope you are enjoying this video. If you are, please share it with your friends and family. Also, be sure to give a big thumbs up to this video before jumping ahead.
Because that's exactly what the market expected them to do, and that's what the Fed does, what the markets expect. But it's not going to do anything regarding bringing inflation down. You know, the elephant in the room with respect to inflation is the fiscal policy. It's the debt, not the ceiling, but the fact that we're running these massive deficits. And until the federal government reduces spending, these quarter-point increases are going to be completely ineffective. And the problem is Powell refuses to call Congress out and mention that the driving force behind all the inflation that they've been creating is reckless government spending. And as long as the government keeps spending, inflation is going to get worse, and so is the current financial crisis. And nobody wants to admit we're in a financial crisis. It is worse than the one we had in 2008. It's just getting started. Ultimately, the Fed is going to cut, but it's going to cut as inflation is accelerating.
The Fed's decision was predictable. However, it was ineffective because it won't address the root causes of inflation. The major factor that is driving up inflation is excessive government spending. The federal government has been running up huge budget deficits for years, but especially since the pandemic. The Fed will eventually have to cut rates again, but that will only make inflation worse. Peter Schiff highlighted that we are heading towards a stagflation scenario, where we have high inflation and low growth at the same time. So, what's ahead for us if we keep going down the Biden road beyond 2024? Let's hear what Peter Schiff has to say on this matter. But before jumping ahead, be sure to hit that like button.
He hasn't accomplished anything other than running up the debt, weakening the economy, and strengthening inflation. You know, the worst part about the weak GDP numbers that came out today was that the inflation numbers that are part of the GDP in Q1 of this year, inflation actually strengthened over the fourth quarter of last year. So not only is the economy weakening, but inflation is strengthening. You have the worst of both worlds. This is stagflation, and it's going to get worse. The real problem is that Paul Krugman still has a job. But, you know, if you look at the jobs that have been created, they're low-paying service sector jobs. So what's happened during the Biden presidency is people have lost good jobs, high-paying jobs with benefits, and they've been forced to replace them with 2 or 3 low-paying part-time jobs. That's where all the jobs are coming from. That's what the numbers show. The only reason we're creating jobs is because we're destroying so many good jobs, and you need to hobble together 2 or 3 part-time jobs to try to replace your lost income, and that means that we have more jobs. But they're not good jobs. They're bad jobs. People would rather have the jobs they lost than the crappy jobs that they're forced to work.
Peter pointed out that Powell has done nothing but pile up debt, weaken the economy, and fuel inflation. The worst thing about the dismal GDP numbers that came out today was that inflation actually got worse in the first quarter of this year compared to the last quarter of 2020. So we have a slowing economy and rising inflation. That's stagflation, and it's going to get worse. What do you think of Peter Schiff's viewpoint of the Fed's rate hike? What's in store for the economy ahead? Would the Fed's action lead to another financial crisis? Let me know your thoughts in the comments below. And don't forget to subscribe to my channel for more updates on crypto and the economy. Also, be sure to hit that bell icon to never miss any video. Hey, thanks for watching, and we'll see you next time. Adios.